Hey traders, Dave here from The5ers Futures. Welcome back. Today we're going to break down Bollinger Bands in the simplest way possible. Now, if you've been trading for a while, you've probably noticed that the market is quiet at times, then it explodes, and then eventually it kind of reverts back to the middle. We can call these three periods the squeeze, the expansion, and then the reversion to the mean. And Bollinger Bands kind of help you determine in which period you're in. Now, let's dive right into the charts and see what it's all about. Now, let's start with the basics. Bollinger Bands are a tool made of three lines. So here we can see the Bollinger Bands applied to my chart. We have a middle line, which is usually a 20-period moving average. To remind you, the 20-period moving average calculates the average price of the last 20 candles. And then it has an upper band and a lower band. And these are usually by default 2 standard deviations away from the middle line. Now, these bands expand depending on volatility. So if the market is quiet, they're tightly together. And then if it expands, well, they move away from each other, as we can see here. So we'll call the first part the squeeze. The squeeze is maybe the most important part of the Bollinger Bands. Let's zoom in into this part right here. So the squeeze is when the market is quiet. So the bands come closer to each other and they tighten. That means that there's low volatility. Why is it important? It's because after squeezes, there's usually big moves because the market can't stay quiet forever. So like here, we saw expansion. So we had our squeeze here, and then we had expansion to the downside in this case. And when the expansion happens, that means that volatility increases and the bands like here move away from the center line. So sometimes when that happens, that means that a potential trend is forming and certainly volatility is increasing. So if you're a momentum trader, that can tell you, hey, it's time to enter my trade. So you might enter somewhere here and ride the lower part of the band. Now, we need to remember the third part of the cycle, which is mean reversion. The thing about price is kind of like a rubber band. Price has a tendency to contract, expand, and then return to the mean. So once price expands, like here, it has a tendency to snap back and return to the mean, which is the 20-period moving average. Let's kind of ride this and see another example. So here we have another period of squeezing or consolidation. And then eventually we get an expansion, first to the upside, then to the downside. Then we revert to the mean and go to the upside and ride the upper band all the way here while periodically reverting to the mean. So if you know these things are going to happen, you can kind of use these lines or bands of the Bollinger Bands to guide your trading. So you need to remember the three periods: the squeeze, the expansion, and the reversion to the mean. Now, in this case, we had 2 trends, and then we had the squeeze again. So the squeeze shows low volatility and a potential breakout. The expansion shows momentum and direction. And then the mean reversion shows when the price is likely to snap back to the average. So when you master these concepts, Bollinger Bands become one of the simplest and most reliable tools in your playbook. I hope you liked this video. I hope you enjoyed what we talked about here. I hope eventually you'll be able to use it in your trading. Remember to follow us, subscribe, like this video, and as usual, I will see you in the markets.